Welcome to Chapter 1 of our series, Tax Basics. Keep more of what you earn. In this episode titled, How Taxes Actually Work, Brackets, Rates, and Reality, we're going to break down the often confusing world of tax brackets and rates so you can better understand how they impact your hard-earned money. Ready to demystify taxes together? Let's dive in. About half of American households owed no federal income tax in 2020, yet almost everyone still argues about tax brackets. You accept a raise, a bonus, maybe a side gig, and then freeze, wondering, will this push me into some invisible danger zone with the IRS? Here's the twist. The number you fixate on, your tax bracket, usually isn't the number that matters most. Two people can both be in the 24% bracket, yet one effectively sends 9% of their income to the IRS, while the other sends 18%. That gap isn't magic. It's the result of how their income is earned and what they do before April 15th. Side hustle versus salary, stock gains versus hourly pay, using a 401k versus skipping it, each choice quietly shifts dollars between different tax buckets. Think of it less like a single bill and more like a box of receipts from different stores, each with its own discount rules. In this episode, we'll zoom out from brackets and look at the bigger picture, effective tax rates, why your real rate is usually lower than you think, and how that can guide smarter money moves all year long. Here's where things get interesting. The number on your paycheck is only the starting ingredient, not the final dish. The tax code layers on adjustments, standard versus itemized deductions, pre-tax benefits, and credits that can quietly erase whole slices of what you earned. Two coworkers with the same salary can end up with very different tax bites if one is funding an HSA, childcare FSA, and 401k while the other isn't. On top of that, some income, like qualified dividends or long-term gains, runs through a different set of rules entirely, almost like a parallel menu with its own price list. 13.6%. That was the median effective federal income tax rate in 2021, while the top marginal rate on the books was nearly 3 times higher. That gap between headline rates and what people truly pay is where planning opportunities actually live. To see it, you have to stop staring at labels like 22% bracket and start tracing what happens to a single extra dollar in different situations. Economists call this the marginal rate, but in practice it's, if I earn $1 more this way, how much do I keep after everything? Not just income tax, but also payroll taxes, lost credits, even higher insurance premiums in some benefit systems. That's why the same raise can feel very different depending on how you get it. A $5,000 year-end bonus that just shows up in your paycheck may nudge more of your income into higher slices and increase FICA withholding. The same $5,000 routed into a traditional 401k could avoid income tax right now and potentially preserve eligibility for certain deductions or credits that phase out at higher incomes. It gets more interesting when you step outside wages. Long-term stock gains, certain real estate profits, and qualified dividends run through their own set of rates, topped at 20% federally, plus a 3.8% surtax at higher incomes. That means a household with moderate salaries but large long-term gains might show a surprisingly low effective rate, even while reporting substantial income on paper. History plays a quiet role too. Brackets, thresholds, and credit rules aren't permanent. They're products of past deals in Congress. The current rate structure, shaped heavily by the 2017 Tax Cuts and Jobs Act, is scheduled to change after 2025 unless lawmakers extend it or rewrite the rules again. That matters not just for curiosity's sake, but for decisions like when to realize gains, how aggressively to convert pre-tax savings to Roth, or whether to bunch deductions in one year versus spreading them. A helpful way to think about all this is like cooking with layered spices. The order and combination you use can totally change the final flavor, even if the ingredients look similar on the counter. Two households with $100,000 of income can end up with radically different after-tax results, depending on whether those dollars pass through payroll, retirement accounts, brokerage accounts, business entities, or certain savings vehicles. Misconceptions cloud these choices. Moving into a higher bracket doesn't punish all your income. Refunds don't mean you beat the IRS. And while high earners do shoulder a large share of income taxes, lower and middle-income households often feel the weight of payroll and sales taxes more intensely because those don't have the same progressivity. When you zoom out to your full tax stack, income, benefits, savings, and spending, you start to see where your real pressure points are. So instead of asking, "What bracket am I in?" a more useful question is, which levers actually change what I keep from the next dollar I earn or invest, and which are just noise? Two quick stories show how this plays out in real life. First, a teacher makes $60,000 and picks up $8,000 tutoring. On paper, that feels like extra money. But the way they earn it matters. If they run it as a simple sole proprietorship, they'll owe not just income tax, but self-employment tax on most of it. If instead their district lets them redirect part of that pay into a 403(b) or 457(b), some of those dollars might skip current taxation and keep certain education-related benefits or credits intact that would otherwise shrink. Now contrast a software engineer at $160,000 base pay who also gets $40,000 of company stock that's been held long enough to qualify for better rates when sold. If they time sales across years, spreading big stock sales instead of dumping all at once, they can keep more gains in lower slices and avoid tripping income limits that quietly reduce things like Roth IRA eligibility or certain child-related breaks. Small shifts in timing and form, not just amount, reshape how much you actually keep. Future changes might feel abstract now, but they'll hit like shifting traffic lights on your money route. Some turn suddenly faster, others jammed. As brackets reset, tools like IRS Direct File and paycheck simulators could act like dashboards, showing how each raise, side gig, or stock sale shifts your next dollar's take-home. Meanwhile, proposals targeting wealth and gains, not just paychecks, signal a slow tilt toward taxing what you own as much as what you earn. Treat your return less like a bill and more like an annual feedback report. It quietly reveals which dollars worked hardest for you and which got soaked. Over time, patterns emerge. Maybe overtime pay stings more than dividends, or selling stocks in big chunks hurts more than in slices. Follow those clues, and your tax plan becomes a series of small, deliberate experiments. Before next week, ask yourself, 1. If I plug my actual numbers into a tax calculator today, what's my real effective tax rate, and how does that compare to the scary marginal rate I've been focusing on? 2. Looking at my current bracket, what specific move could I make this year, like increasing my 401k contribution, timing a Roth conversion, or bunching charitable donations, to deliberately shift how my next dollar is taxed? 3. When I look at my last tax return line by line, which parts do I not actually understand yet, like credits versus deductions, or the difference between taxable income and AGI? And what's the first concrete question I'll bring to a friend, CPA, or trusted resource to clear that up? This was Owl Up, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow.